The events unfolding on the streets of Athens and in the international news media constitute a Greek tragedy of epic proportions, which has shaken the world and continues to unsettle the Eurozone. Greece's future in the Eurozone is in serious jeopardy. The country has just experienced the largest sovereign debt restructuring in history after its bondholders across the globe accepted a debt reduction once the spectre of Greek default became inevitable. These events have tested market resilience and have had a destabilising consequence for the global financial system. It is correct now to pause and assess the good, the bad and what to expect should a similar event occur within the Eurozone.
Focusing on Greece to start, there are some views that paint an apocalyptic type scenario with mass unemployment, inflation pushing 50%, a long and very deep recession, run on the banks and a complete paralysis of the financial system. However, I believe some of these scenarios will be watered down a little and some could be mitigated in some way. On the face of things, Greece is small in economic terms, contributing to around 2.5% of Eurozone GDP. However, a voluntary or forced withdrawal from the Eurozone will undoubtedly draw some closely correlated economies into the beginning of a similar demise, all, however, with adjusted characteristics. Spain, Portugal and Ireland come to mind, each with their own characteristics. Although Spain is firmly in the crosshairs as we speak, with more pressures being applied, making it look more likely they'll be requesting further bailout from the ECB. However, this time, Germany aren't fully behind the impending request. Ultimately, where we go from here to see some heightened volatility when any type of Eurozone exit is on the cards from any of the given countries mentioned. And the worry for most analysts, economists and policymakers, well, will be the self-fulfilling prophecy that ensues, which can blow out any type of orderly exit.
Firstly, sovereign debt levels are high and are still rising. The IMF is expecting the average euro area debt to GDP ratio to peak next year. For France, that will be 2014. For UK and US, that will be 2015. Perhaps more worryingly is that Spain's debt to GDP level isn't expected to peak even within the next 5 years. So in that context, I would not expect the euro debt crisis to be solved within that sort of time frame.
I think it's very difficult to look at it that way. I think you have to look at the Eurozone not in isolation, but as perhaps an episode in a mini-series which all started off with the US subprime crisis, which will develop over the next few years. We are in a position of debt deflation in the West. And as we go through what's called a Kondratiev winter, other countries will be brought into this, whether that be Japan again with their demographics or with the United Kingdom or China. Other players will come into this, the problems that are currently being faced by the Eurozone. I think with Europe itself in isolation, if it were to be successful and the euro to continue, probably within 7 to 10 years, you may be saying that we're coming out the other side of it.
Well, the Eurozone sovereign debt crisis has already been running for around 2.5 years now, and we're by no means halfway through. So I would expect, and particularly given the current pace of resolution, I'd expect the crisis to last for at least 5 years. And while it's impossible to put a date on the final resolution of this, I'd expect the effects of the crisis to last for at least a decade after the crisis has even ended.
Customers and clients need to be prepared in such a way where they're given clear and precise communications. They need to be given scenarios and have choice of what best fits their situations. They need transparent market knowledge in news, data and research. They need a banking system that's ready for many eventualities. They need to be prepared personally for the fallout in a worst case scenario.
We will see a situation where the EU, the IMF will come in and they will restructure the banks. We'll have a new currency which will trade at something between a 50 and 70% discount to where it is in Eurozone terms. But one would expect that stock markets in Greece would start to perform very well. There's certain industries which have been very hamstrung by the strength of the euro, and they would, particularly tourism and shipping, things like that, would start to perform incredibly well.
Leading off with this increased market volatility and inevitable self-fulfilling prophecy, the risk of destabilisation on both the Eurocentric and global scale could be severely underestimated based on current model scenarios. We all witnessed the fallout in the banking crisis back in 2007 and 2008, and the knock-on effect that had on both the general markets, CDS, debt and interest yields, currencies, and of course the asset-backed universe. Many of these drastic moves came from a logical market adjustment to the cards that have been dealt, although some of these adjustments were based on market perception, which was more self-fulfilling. It's important to highlight this issue as the central banks of the world and the global economists whose job it is first and foremost to control and disseminate sound information and policies to bring confidence and clarity into these markets. But the risks connected by disinformation and steadfast policy can very quickly become undone. And the fallout risk could turn a controlled ring-fence exit into a less controlled affair. We can cast our mind back to the images of anarchy in both Greece and Spanish streets, which was the only way citizens on the ground felt their policy and their voices could be heard. We need to learn from these mistakes and ensure that policymakers make the decisions that are fair and balanced, but also managed and feasible for their economies.